Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. My name is Bryce, and if you've just joined us for the first time, a massive welcome to the podcast and to the Equity Mates community. Now, today we are sitting down with a returning guest to Equity Mates, someone that we haven't spoken to in a while and has had quite the journey in markets. So we're really excited to introduce our guest in a moment. But before we do, a reminder that Equity Mates is going live in Melbourne on Wednesday, the 10th of July. We cannot wait. We're coming down and we're going to be doing a live podcast in the city on Wednesday, the 10th. The highlight being Ren and I will be doing a live Pimp My Portfolio with Luke Larrative. We'll be showing our portfolios and going through every single position that we have to get Luke's thoughts on how we might be able to improve our own portfolios. We're also bringing in an advisor for an Ask an Advisor session where you guys can ask all your questions, and we'll be unpacking all the news headlines just like we normally do. So a big thanks to Scarcity Fund for also sponsoring and making the event possible. And tickets are available, equitymates.com/events. They are selling quickly. I think we've only got about 25% left. So make sure you grab one, equitymates.com/events. We cannot wait to see you there. But today's guest is Tim Samway. Now, Tim used to be Managing Director of Hyperion Asset Management, and that's how he appeared on our show in previous years. He then went on to start Packhorse and is now a general partner for Scarcity Partners, a private equity firm, which is what we'll be focusing on today. So very excited to get stuck into this one. So without further ado, here is our interview with Tim Samway. Well, Tim, welcome to Equity Mates.
Pleasure to be here.
The Equity Mates audience would probably remember you from when you previously appeared many years ago in your role at Hyperion.
Yep.
But you've had a journey since then. So let's just start with an introduction to yourself for those that have joined the show for the first time and haven't heard of your story. Can you talk us through public equities at Hyperion and the journey since then?
Sure. So I spent 20 plus years at Hyperion Asset Management, who was a startup. I mean, we started with 1996 with a group of people who had an idea about investing, growth investing in equities, and we built it over, it's nearly 28 years now. And it's a $13 billion Australian and global equity manager today, and it's right up there against every fund that invests in those areas in terms of returns. So it's been an outstanding story. I loved Hyperion. I loved building things, and I loved being part of a team that built Hyperion. It was a team effort. And I think I learnt a lot along the way about building businesses, and there was a time where I woke up one day and thought, okay, so it's Groundhog Day. Another year at Hyperion. And, I'm in my 60s. I thought I might have a go at something else here. So I handed over my shares in the business, succession capital to the younger guys. I was pretty happy about doing that. They were, they needed equity to be aligned with the future of the business. So I was pretty happy to do that. And I got a great opportunity, which I think I might have mentioned the last time I was on in 2022, to build an agricultural funds manager with a very dear mate of mine, Tom Strawn. He's a Queenslander, and he's a man passionate about regenerating agricultural land. He was from Roma as a child and lived on a property, and he just bought a very substantial property in 2012 to run cattle. And we had a goal of buying, millions of hectares of Australian agricultural land and regenerating it. So really what that meant was changing the way that the cattle were run, improve pastures, improve the production, and sequestering carbon. And we were on our way with Packhorse Limited, which is Packhorse Pastoral Limited, which was an Australian fund that we'd set up. And a terrible stroke of fate, he and his son were killed in a plane crash in 2022, August 22. And so I'm not the cattle guy. So Tom was the cattle guy and I was the funds management guy. And we decided to wind up Packhorse, and we're in the process of doing that. We've sold our properties, and everybody who put their money in at $1 will get $1.13 back. So that just tells you investing in agricultural land is an outstanding opportunity, but it wasn't to be. And it left me sitting there wondering what I was going to do next. And an old mate of mine, Adrian Whittingham, who was at Pinnacle, and as you might remember, or some of you may know, that Pinnacle, which is a listed Australian company, has holdings in I think about 16 funds managers. That's their business. They're an affiliate model. They own minority shares in fund managers, and Hyperion was one of those. In fact, Hyperion was its first. And Adrian was on the board of there, and he decided to do exactly what I did. That is, Groundhog Day had come along, and he decided to go out and do it himself, so Pinnacle Mark II. And he gave me a call, and I said, I'm in. I just can't miss an opportunity to build a bunch of fund managers in Pinnacle Mark II. And that was the start of it. We've got 6 founders who've created a business called Scarcity Partners. And our job is to find investors for a fund that can invest directly into the equity, not the funds, the equity of Australian or Asia Pacific fund managers. And so deliver the sort of returns that Pinnacle's been able to do for its investors. And just to frame that, Pinnacle was a 20-cent share. You could have bought it on the stock exchange as Wilson HTM. It had an affiliate model. I think it offloaded the broking business and became Pinnacle at about 90 cents. And today, I don't check it every day, but it's $11 a share or thereabouts. Wow. And so it started at a $20 million business. It's now a $2-point-something billion business. So it's a unicorn. It's a unicorn built on investing in fund managers.
So for context, in about the middle of March, I've just looked up the notes, we did the top 5 ASX stocks of the last 10 years, brackets, that aren't mining stocks. And Pinnacle was 5th on that list, up 1,889% in the past 10 years.
There you go.
So almost 20 bags.
And that's investing in fund managers. And Pinnacle's still available. You can still invest in it. It has 16 fund managers. Some of them are really well-known Australian names. Hyperion's one of them, but Metrics Credit, you guys have probably come across them, a substantial success story. Pinnacle bought into them. They had about 300 million under management when they bought an equity share, I think it was from National Australia Bank. And today they've got, I don't know the exact number, but it's over 15 billion under management. That's been a true success story in Australia. There's a bunch of others.
And it's not just public equities. Correct me if I'm wrong, but there's like VC funds and a few different types of...
They've got a bunch of different investments. A lot of their managers are in public equities. They've got different types, but no, they've got some private...
Bonds as well? Chris Joy, is he in the...
Yeah, Coolabah is one of them. Yeah. Where we vary is that we're not going to be a publicly listed company. We've got a fund which you can invest in, which invests directly into the equity of the underlying fund managers. And I think I can predict pretty firmly that our focus will be on private markets rather than public markets. That is, bringing more Australian equity managers to the market is probably not necessary. There's already quite a few, and it's pretty hard to display and capitalise on a competitive advantage in that area. So competitive advantage in public equities is pretty hard to demonstrate and capitalise on.
So I want to get into some of that thesis and a little bit about the managers that you've already got, but just help us understand that structure a little bit more. So Pinnacle is a listed company. If people want to go on the journey with Pinnacle, they can just buy shares in Pinnacle on the ASX. But you've got a fund.
What's different? So Pinnacle is the affiliate model. They provide shared services to a lot of the fund managers. So they're providing distribution, HR, IT, compliance, whole range of services. So there's 150 plus people working at Pinnacle. And so while they have investments on their balance sheet in those underlying fund managers, the profits come up through Pinnacle, and of course they're filtered through a fairly substantial payroll. Whereas we're running it as a fund, so your investment in the fund invests directly into the equity, it's transparent, and the only fee that comes out of that is us as a manager charging the fund a management fee. And so it's a much more direct approach. We're not offering shared services, we're not doing their HR, any of those things for them. What we're doing is we're finding best in market. And I think that's what's changed over the last 10 years is back office services. I know this is incredibly boring.
No, it's interesting.
Back office services, whatever they be, have improved very substantially in the outsourced model. It's no longer necessary as you're building a fund manager to actually have all of that insourced. In fact, it's more efficient to have it outsourced. But it doesn't change the underlying model of a fund manager, and that is most fund managers are fixed cost businesses. And once you get past a certain point, we call it the J curve, it's obviously you spend a lot of money early on, you go down in a big dip, and then as you raise more funds under management, finally you get into profit. Well, the reality is once you get into profit, you could add $1 billion of funds under management and all the revenue that goes with that, and you don't add much more in costs. So if you look at what's called operating leverage, and that's what that is the return you get for every dollar of revenue over cost, it's very substantial in fund managers. In fact, it's the second in the world after software as a service. It's a very advantaged industry. And we see that happening in the US. So this model is widely used globally. There are about 45 firms doing what we're doing globally. They're called GP staking firms, GP standing for general partners. They're talking about the general partners of a fund manager as opposed to the limited partners, which are the institutions that invest in the funds or invest in the funds. And so GP staking has gone from nothing 15 years ago to a $50 billion US dollar industry in that time. And some of the biggest private equity businesses in the world have now substantial GP staking businesses, names like Blackstone, Blue Owl. I could go through all 45, but I'm not going to do that. The reality is it's become a very select section of private equity that has enjoyed a lot of success, because actually if in funds management businesses, you're actually in an industry that is very advantaged because you're advantaged by the underlying growth in the assets. So even if as a fund manager you don't raise another dollar, generally the assets you're invested in go up year after year, and so do the fees, because they're calculated in basis points or in a percentage on the underlying assets.
So one of the big differences, this is a subsection, what you're doing, a subsection of private equity.
Correct.
And I guess one of the biggest distinctions is that you're taking minority stakes. You're not coming in and taking a big whopping majority and trying to transform the business.
Correct.
What value are you adding to the fund managers, or what are they looking at you for instead of just going and getting a larger check from some of the big guys?
Yeah, so that's a very important distinction, the difference between private equity investing, where you often go in and buy the whole business, you allocate some equity to the senior management, a small proportion, and then you've got a shot clock running that says we've got to do this by a certain date and then we're going to sell it. We're an evergreen fund, and there's no shot clock running. We're thinking about being married to these fund managers for long periods of time. We want them highly incentivised to build the business over time, and that's why we believe a minority stake is important. We put in minority protection so they can't all ramp up their salaries and take all the profits as salaries, for example. But by and large, what we bring to the table is the extra experience that comes from having done this over the last 2 decades, giving them launch pads into areas that they otherwise wouldn't be able to do. So what I mean by that is there are some terrific fund managers out there. I mean, we've seen over 150 in the last 12 months. They've just come to our door seeking the assistance we give them. And what is that? Well, normally they're very good at managing money. You don't get into funds management unless you're smart, you understand financial assets, and you've learnt how to put aside all of those normal investor behaviours that actually make investors lose money, like, all that dumb stuff.
Yeah.
And so often they're really clever at investing, but they're not so good at running businesses, and they don't know how to build a business themselves, or they may, but they're mostly focused on running the money. And there's a generally held perception that build it and they will come, but a lot of them have built it, done terrific returns, but haven't been able to add the funds under management. And what we bring is the experience of having done what I'd call channel extension. That is, they might have won money from their family, their friends, some family offices, and maybe an institution. They've got 300 to 500 million under management and they can't grow any further. And we can introduce them, for example, to the wealth network, and we can get them onto platforms. We can get them rated, we get them into model portfolios, and all of a sudden they're adding hundreds of millions of dollars. And of course, the benefit to our investors in our fund is that they get that exposure to all the upside of profitability from a business that's already profitable, but can actually hyper scale at this point. So it's really all about scale.
Yeah.
Sometimes it's a product extension. So they've got a really good product, but there's an obvious extension to that product.
It's pretty interesting. It's like, pinnacle of their value proposition is we'll do all the back office work for you. Your value proposition is you have 500 mil, give us a stake and we'll get you to 5 bill or 50.
That's it.
Yeah.
That's it. And the way we do it is by thinking about their competitive advantage. That is, we want the best in a particular domain. And what we want to do is grow their competitive advantage. That increases their value. So if they've got a moat of some sort, this is not very different from what the philosophy was at Hyperion. We're thinking about long-term growth businesses. We're thinking about the opportunity to take that competitive advantage and grow it. And that might be by investing the capital that we put in through our fund into more in the investment team, for example, to make the business more institutional and make it attractive to more investors.
So when I think GP staking, and this is probably just a lack of knowledge on my behalf, I often think of it as like you're finding someone who doesn't have a fund and you stake the fund. But in this instance, it's more you find smaller funds that have potential.
Yeah, we're looking for people who've already made it through that J-curve. We want them to have some skin off their knees and some bruises. We want them to have proved their ability to do what they can do under difficult circumstances. We've got 12 kill factors that we think about when we're sitting opposite them. And
12 kill factors as in, like, we're out of this deal?
Correct. One of those kill factors, we're out. One of them, for example, is scale. So we're investing our investors' money in the equity of this business. So if they can't get to scale, because scale is the thing that drives the profitability. So if they've got very low views about what they can build their funds under management up to, we don't want to be there. So if they only want to double the size of their business, that doesn't allow us, for all the work we're going to put in, to actually make it worthwhile to put the investment. Other is track record, but the most important thing is actually the quality of the founders. It's a marriage. We're getting definitely into marriage for a long term with these founders. We want to know these guys and girls are good at what they do and they're open to our suggestions, and they want to work together to build a better business that produces better returns for their investors, and the subsequent nature of that is, of course, to be able to build value for our investors in the equity of their business and return dividends. I mean, this is all about cash flow and building a business that ends up paying monthly dividends.
Nice.
So what's the universe that you're playing in? Like you mentioned 150 have come to you in the last 12 months. Like I look at Pinnacle and they've got some like gold class funds in there at the moment.
Yes.
So it's like, are you looking for the up and comers? Just talk to us about the universe here in Australia.
So great question. So the universe is mostly alternatives. So private investments. They include private credit, infrastructure, distressed debt, private equity, venture capital, real estate. There's all of those type of managers. And by the way, I mean, we might get to this later if we've got time, they're the sort of investments that your listeners actually find it quite difficult to get access to because they're not listed, and often they're sophisticated investor investments, and actually a lot of them are not even offered to sophisticated investors, they're just offered to institutions. And so while they might have some exposure through their investment in their super fund, their major Australian super fund who's probably got some exposure, what we're trying to do is give them exposure to the manager, and the manager, interestingly enough, has not only exposure to the fund, because that's where they make their money out of that fund growing, they also make money out of the fees that they get on the fund, and they get return on their performance fee, which is called their carry. And so our investment gives them exposure to all three of those things rather than just the investment to the fund. We would rarely just invest in the fund itself. Like, we're not into putting to address your question, we're not into putting money into the fund.
Yeah.
We'll put money into the fund manager, and then the fund manager shows their alignment by investing directly into the underlying fund. And that's what investors want to see, fund managers who put their own money where their mouth is into their own funds.
Yeah.
So Tim, we're going to take a quick break here, and then on the other side, I want you to introduce us to some of the fund managers that we're talking about, and then I've got some more general questions about private equity in Australia that I want to get to, but we'll quickly take a break.
Wonderful.
Welcome back to Equity Mates. We're talking to Tim Samway, the founder and chairman of Scarcity Partners. Tim, we're talking about GP staking, something that we obviously don't know much about, so it's interesting to learn. We've spoken about it, I guess, theoretically, but it would be great to actually be introduced to some of the fund managers. I think you said there's 6 so far, is that right?
No, we've got 1 that we've invested in and
my
5
mistake.
that are in due diligence. No, your numbers were right.
Yeah.
Let me talk to you about the one that we've invested
Please,
in. So we went out and did a cornerstone fundraising before Christmas last year over 8 weeks. And we bought a 30% interest in a company called Evidentia. Now, a lot of people will have never heard of Evidentia. They are an outsourced CIO, Chief Investment Officer, business. It's a very common model in the US. They offer separately managed accounts to wealth businesses, so that the wealth business can focus on all the advice around structuring and financial planning, and they've effectively outsourced the investment component to Evidentia. And Evidentia, if you're a wealth manager or a financial planner, you say, this is the type of investments we like, this is our general philosophy, and then Evidentia build those portfolios and run them for you on platforms like NetWealth and Hub24 and the others. And then they produce the reporting, and then they actually do the education of, effectively the investment education of the client. Why that's good? Well, they can deliver a lower cost of product to the wealth manager because they've got scale advantages. They can negotiate with the fund managers, and they've got scale advantages with the platforms, so they can reduce the total cost to the platform. So the financial planner wins on the cost side. They can deliver a lower cost to the client who's gone to the financial planner. But the big benefit is the financial planner gets about a day and a half, a week back, where they don't do investment work, where they can focus on servicing their clients and winning new clients. And they only started just under 4 years ago. And when we signed our first non-binding offer with them back in September, they had around 6.1 billion funds under management. And today, here we are, less than 6 months, they're at 8.9 billion under management. Wow. They are growing very rapidly, and that's our first investment.
So how are they driving that scale? Like, is your game now convincing more wealth planners to use the product, or just the wealth planners put more money in? Like, where's that scale coming from?
It's a bit of both. So they are a disruptor. This market is really open for disruption. If you remember, after the Royal Commission, there's been a strong separation, particularly in the big channels like the banks, with a lot of advisors coming out looking for those investment services that they were previously getting through the banks. And there are two models here. One is it's just investment consulting, where an investment consultant says, I'll give you the ideas of how you would do this. And then there's Evidentia doing the totally wrapped service, which is we'll do everything for you and gain some cost savings. So it is a very disruptive opportunity for Evidentia. And their growth, which is your second question, is what happens is when a big practice, say it's $1 billion practice, they've signed up, they don't do it all on the first day. What happens is over a period of 12 months, maybe a bit longer, one by one their clients are slowly transferred to this. So when we went in to invest in Evidentia, we could see a strong pipeline of effectively of a process of transformation over time, where they would take financial planning business, and over time they would go from naught under management to $1 billion under management. And when we entered, they might have only been halfway along that way. So we've got a pretty good idea of what their pipeline looks like. And on top of that, they're out there winning new business.
So they're not exactly a traditional fund manager that you would... No. But do they make money like a traditional fund manager? Management fee and performance fee?
Yes.
Yeah, okay.
Mostly management fee. It's a scale game.
Yeah.
So once again, it's as they build their business from 8.8 billion to where we think it can go into tens of billions of dollars extra, their costs don't go up very much. So it's that operating leverage opportunity I talked about earlier.
Nice. It's fascinating.
Yeah. So anyway, we've done that deal with them and we're married to them. A part of our organisation is very focused on growing that business for them and adding opportunities for them. So adding extra product and services that they can deliver to their clients, once again, to build on their competitive advantage. Because we think that's their major opportunity, is to strengthen that competitive advantage.
Now, you mentioned that a lot of the fund managers you're looking at won't be in public markets, they'll be in private markets. And this has been a big trend we've seen over the past, call it 10 years, I guess. A lot of institutions are increasing their allocations to private equity. Private equity as an asset class has massively outperformed public markets. Even Bryce is now jumping on the bandwagon, and he's desperate
can't get enough of it.
Desperate to get into it. So I guess let's
Which
start.
probably means it's at its peak if I'm jumping in.
Yeah. So watch out.
Not at all.
So give us the case for private equity. Yeah.
So a lot of these alternatives are substantially underrepresented in investors' portfolios. And we think that is a huge wave that's going to come through the Australian market, particularly over the next 10 years, as they become available. For example, you may have noticed that Net Wealth did a very interesting deal, I think it was last year, with a platform that will enable them to deliver 1,400 alternative managers directly out to their clients.
Oh, wow.
Wow.
Yeah. So that's
those wrap platforms need to make one for an everyday investor.
Yeah. So I think that's a really interesting opportunity. Our fund is going to be listed, is listed on Net Wealth. If you've got a financial planner or a wealth manager who's got access to a platform, you can now access our fund and you can also access a whole lot of other private equity. So that's where it's changing. I mean, if I look at the major Australian superannuation industry, there are plenty of funds there who've invested billions of dollars in private equity type investments, so private investments. And that is everything from private debt, infrastructure, real estate, all of those private assets that never make it to listed markets. And they've made a lot of money out of them, and the returns have been high. If you look at them, the median return over 7 years from 2013 to 2020, that's the only numbers I've got from Preqin, the median return was 14.5% return.
After fees?
Yeah. I mean, it's just outstanding. Okay, so they're real numbers. And if you look into the family offices, there are a number of family offices I know who have a third of their assets invested in private investments. Now, there's obviously a trade-off for that high return. It's called low liquidity, and some of these funds aren't particularly liquid. So you've got to take a long-term view. It's a challenging thing for a lot of investors to know that you're putting something into a fund and it's not liquid. You can't get it out tomorrow morning. But I think investment is a long-term game, and liquidity, you pay for a lot for liquidity if you're prepared to accept, sort of single-digit returns. So I think what you're going to see is a high lift, a substantial lift in the number of financial advisors and just direct investors who aren't advised going into private equity, private assets over the next 10 years. So there's a massive tailwind there.
Unfortunately, it is still quite inaccessible for
Correct.
the everyday Aussie investor.
Because
I'd love to have a third of my portfolio.
So no, we accept that completely.
Yeah.
So I think the wrap platforms are a great solution for this. Like, it's great that NetWealth and Hub and all of them are making this world more accessible, but you need an advisor to access a lot of those platforms.
So NetWealth has
They've got
direct
small retail. Yeah.
No, they have it direct. If you've got you still need a fair bit of money, but it's pretty reasonable, and you can make $100,000 investments into some of these funds. Now, I know that's not retail.
That's not the accessibility we're looking for.
No, I know that, but it's just the next step. Everything it'll get there.
Yeah.
Everything happens in steps. One of the challenges with a lot of these private equity funds is they can't put them on a PDS because they don't fulfil the liquidity rules. But we're thinking about how to deliver better liquidity. It might be an ETF. There are real opportunities. They're managed funds, so there are real opportunities to get this out to retail land. Obviously, the government's thinking about restricting the availability of sophisticated investors, and these are terrific opportunities. And if I look at my experience over decades now, there are many opportunities that have returned absolutely outstanding results with very little downside risk in infrastructure, for example, which should have been available
100%.
to your retail investor. Would have been a great investment for them. In terms of trying to regulate those who are a bit shonky in the market, they've over-regulated, in my view. But, education is what it's about, and you guys are doing a good job on that.
Yeah. So one thing that we always talk about when it comes to private equity is accessibility. The other thing that I think about with private equity is, especially in a smaller market like Australia, like, when do we get to a point of oversaturation? And I'm not saying we're there yet, but I guess I'm interested in how you think about that.
We're not even close. So the numbers in Australia are, the Australian public market is about 1.6 trillion and the private market's about 139 billion. Long way to go. I mean, in the US, for example, the public markets are about 50 trillion and the private market's about 7.7 trillion. I mean, these are very substantial markets, but they've got a long way to go. I mean, direct, non-bank credit is a real opportunity here in Australia. So the non-bank credit market is still a fraction of the total credit market, whereas in the US, it's completely the opposite. Most credit is private credit in the US. It's about 50-50 in Europe, but here it's growing so rapidly because the banks are just so restricted in what they'll lend for.
And there's no regulatory reason Australia's a lot smaller. It's just we're a bit slow on the uptake.
It's just slow on the uptake. And you see businesses like Metrics Credit who've gone from 300 million to nearly 50. I think it's pretty close to 15 billion in a very short period of time.
Wow.
Because it's an attractive opportunity for the borrowers and it's an attractive opportunity to the lenders. I mean, when you can get... this is not investment advice. Please don't take it as that. But their funds are offering, 10, 11% with a very large number of borrowers across that. That's a pretty attractive investment.
With a number of fund managers out there, yourself included, what should we be thinking about as we go through the journey of wanting to get into some private equity? Like, what should we be looking for in terms of fund managers?
Well, perhaps I can just give you a reflection on what we're looking for, because you should be looking for the same thing.
Yes.
Okay.
Yeah.
So, it's very easy just to look at a fund manager's track record and go, great.
Yeah.
Because I can tell you that's a lot of investing just gets done on that basis in Australia.
Yeah.
It's not right. And often it's just the last couple of years of track record, and it's momentum investing. It's this fund manager is doing well at the moment, I will invest with them. I refer you back to the things that we think about. We want sustainable long-term businesses to invest in. Clearly, you get a bit of a guide if you're looking at the ratings agencies, but they're not doing the sort of deep dive that we do. We go right through legal due diligence, financial due diligence, and we spend a lot of time with the founders. This is not a 2-hour review meeting where we sit with a couple of portfolio managers and ask them some questions. We take them to lunch.
Nice.
We pour a bit of alcohol in them.
Yeah, we get them pissed.
See what happens.
Get the truth out.
Jesus, sounds like a pretty good job you
really
run.
like the truth serum. Yeah. No, I wouldn't say we do that all the time, but we think about investing in a very long-term sense. So what we're trying to do is understand whether this business can deliver real returns for a long period of time. And so I guess we're thinking less about beating a market and whether we're in terms of what that fund manager can do, and more about can they deliver real long-term returns to investors. That is this a great value proposition to investors? We're constantly thinking about, what are the things that could go wrong here that would leave our investors and the investors in their underlying funds unhappy. And that very holistic view is the thing that I think people should bring to manager selection when they're thinking about putting money. It's not just the last 5 years' returns. And in fact, the evidence is pretty clear. Looking at the last 5 years is not enough, just on face value, is not enough to determine whether it was luck or skill.
Yeah.
You've got to get... The period's got to get 20 years before you can really make that determination, and you need to understand what the underlying conditions were during that period. There were lots of periods where I was at Hyperion where we were last on the surveys because we were a growth manager in a value period. But then when the growth markets came back, we were top for years and years and years.
Yeah.
And so you just have to look at things through a different prism. And I do think investors have to be really careful of just looking at returns.
Well, Tim, I think that's a great place to end it. Thank you so much for your time today. If you're listening at home and would like to know more, head to scarcitypartners.com and there's more information there. But Tim, thank you for your time. It's been wonderful to get you back on and hear more about what's going on in private equity. So thank you very much.
Absolute pleasure. Thanks, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.